Okay, good morning, everyone. So, we're going to be carrying on what we started last time we were doing face to face learning, where we were looking at calculating break even quantities for a business and looking at break even charts. So, for your classwork today, I won't ask you to actually do one of the charts, but you'll be doing some of the working out of the fixed costs, variable costs, profit loss, all of that stuff, and putting it into a table. And I will go over how we plot one of those charts in this video, but you yourselves, you won't actually do a chart, just a table and some questions that'll all be on Google Classroom. So as a reminder, when we're talking about a business breaking even is when the revenue, so the money coming in, is equal to the money being spent. So think about any company. Let's say we're thinking of just a clothes shop or something. So that clothes shop will have expenses. It's got to buy clothes in or make its own clothes. It's got to pay staff. It's got to pay utilities. It's got to pay rent or a mortgage on the shop. So it pays for all of those things. Those are costs. Then what it sells is the revenue. But just making revenue doesn't mean you're making profit. Profit only comes when you are over breaking even. So when you are making more money through sales than you're spending on costs, you're in profit. When you are spending more on your expenses than you're making in sales, you are making a loss. Okay. So when we're understanding costs, it's really important to know the difference between a fixed cost and a variable cost. So a fixed cost is something that will stay the same every month or every unit of time you look at. So regardless of how many goods you're making, how much you're selling, it stays the same. So those are normally things like staff payments, if you have staff on salaries, the rent on the shop, maybe advertising costs, they stay the same pretty much month to month. Variable costs change, and they're often linked to how much goods you're making. So if you're producing more clothes, in the example that I had, you'd be spending more money on that. So that is an example of a variable cost. So how much you actually spend on your stock, that will increase over time. So on Google Classroom, you've got an example of a burger van company. And I do recommend now you quickly pause the video and open up that document because I'm going to go through some parts of that. So if you have that open. So I've just gone over here. These are the fixed costs for the burger van. So, running the van, the business tax, the salaries and the adverts. That adds up to $3,200. And then for the meals, the variable costs are the food, the packaging, and then extra wages for any casual staff, which adds up to $12 per meal. Okay. And a meal is sold on average for about $22. So they're making $22 per meal, but every meal is costing them $12. Then they've always got this fixed cost of $3,200. So we did this in class last week, and I want you to fill in the table on Google Classroom. I've started it for you here though, so just as a reminder of how this works. So we've got the quantity, so how many meals they're serving going down here. I've only done the first few, but you've got it all the way up to 600 on yours. So first of all, the revenue column. All you need to do for the revenue column is you need to do the number here multiplied by 22. So when you're serving 0 meals, that's 0 times 22, you're making $0. When you're serving 100 meals, that's 100 times 22, you're making $2,200. Next, we've got the fixed costs. Now, the whole thing about fixed costs is they do not change. So for all of these, the fixed costs will always be the same, 3,200, based on those calculations up here. Next, we've got the variable costs. So for the variable costs, what you want to do the number here multiplied by the total variable costs, which was $12. So for 0 meals, 0 times 12 makes 0. For 100 meals, 100 times 12 makes 1,200. Then you've got the total costs, where you just add together the fixed and variable costs. So just an addition, this plus this. And then finally, you've got profit or loss. So for that, you do the revenue minus the total costs. Okay, so revenue minus total costs. If that gives you a positive number, you are making a profit. If it gives you a negative number, you are making a loss. So as I say, we're not going to plot a graph on this today. We may look at that in another lesson online, or I may just wait until we get back to school, depending on how this lockdown goes. But what you want to be doing on a break-even chart is you want to plot your unit sales along the bottom. So I've got burgers here going from 0 all the way up to 800. And then you want to do money up the side. So I've got costs and revenue up here going from 0 all the way up to 12,000. What you want to do is for each number, you want to plot both your revenue, so plot it for each one, then draw a line, and then your total costs for each one, and then draw a line. And like we saw last time, you eventually get to a point where the revenue and the total costs cross over. That is the break-even point. Any point above there, the company makes profit. Any point below there, the company makes loss. So you can use that to calculate exactly how much the burger company needs to sell to produce a profit. So, like I say, the work that you need to do is on Google Classroom. If you need any help at any point, I'll be available on Google Classroom through to the end of the session. So good luck and log in if you need any help.